Welcome to today's lesson. So I want us to complete the workbook that we had. I think we had remained with one or two questions. Yeah, the question for group, and the group accounting, or the consolidated one, the one for Polo. So we shall start with that one as we move to complete that, and maybe start the other workbook that I had shared, I think, in the course of the day. And I will read through. There is one. And it reads that that is a question for the group. Apollo Limited acquired 90% of the ordinary shares of 10 per value in Solo Limited on 1st November 2021, paying 30 per share. The balance on Solo Limited retained reserves at this date was 9,600. On 1st May 2023, Polo Limited acquired 30% of Alo Limited, 10 shillings ordinary share for that 5 per share. The statement of financial position for the three companies as at that 1st October 2023 are provided below. So we have the statement of financial position for Polo, Solo, and Alo. So I've been given that statement of financial position. Then additional details relating to the revenue reserves were as follows. We have the one for Polo. Just I had a little hitch on my internet. So we are looking at this question on Polo. Question on Polo. And I will read through. I'll just start it from the beginning. So Polo Limited acquired 90% of ordinary shares of 10 per value in Solo Limited on 1st November 2021, paying 30. The balance on Solo retained reserves as this date was 96. On 1st May 2023, Polo Limited acquired 30% of Alo Limited, 10 ordinary shares for 35 per share. The statement of financial position of the three companies as of that 1st October 2023 are provided below. So we have been given this, the one for Polo, Solo, and Alo. And additional, number one, the details relating to the revenue reserves were as follows. So Polo, Solo, and Alo, revenue reserve on 1st November 2022, and retained earnings for the year ended that 1st October. So I've been given that. Number two, it is a group policy to value non-controlling interest at acquisition date at fair value. The fair value of non-controlling interest on 1st November 2021 was 3,600 million. Number three, a check of 80 million from Solo Limited to Polo Limited was not received until 3rd November 2023. Intercompany balances are included in the accounts receivable and payable as appropriate. And number four, in October 2023, Polo Limited sold goods to Alo for 780. These were transferred at a markup of 30% on cost. 2/3 of these goods were still in the inventory of Alo as at 31st October 2023. Just prior to its acquisition, Solo Limited was successful in applying for a 6-year license to dispose of waste product. The license was granted by the county government at no cost. However, Solo Limited estimates that the license was worth 2160 at the date of acquisition. On 1st November 2021, Solo Limited owned an investment property that had a fair value of 1440 million in excess of its book value. The value of this property has not changed since acquisition. So we are required computation of goodwill on each investment. And the number B, group statement of financial position as at that 1st of October 2023. So we need first the group computation of goodwill on each investment. So each investment is investment in Solo and investment in Alo. And then we calculate the group statement of financial position. So first we need to know the relationship. The relationship between this. I can do my workings on this end. and do some workings on this end. Workings. And the first one is for the group structure. Group structure. And then look at the group structure. We are told that Polo acquired 90% of ordinary shares of 10 shillings per value in Solo Limited on 1st November 2021, paying 30 shillings per share. So we acquired 90%. Polo acquiring Solo. So here we have Polo. Okay, Polo, and we have Solo. And here we acquired 90%. And he said we have what we call the NCI, the non-controlling interests. They will acquire the balance, of which the balance is 10%. The balance is 10%. So we are acquiring 90% of Solo, making Solo a subsidiary of Polo Limited. And the non-controlling interest in this case, they are owning 10%. And remember, this one was on 1st November 2021. November 2021. And we are reporting on 31st October 2021. So that was at the beginning of the year. Yeah, because October, and that means if the year is ending October, the year started on November. Yeah, October, November, December, so November. So we acquired it at the beginning of the year. That was on 1st of November 2021. Then the second one, on 1st May 2023, Polo Limited acquired 30% of ALO. So here we have ALO. And for ALO, we acquired it 30%, making it an associate. Remember, this one will be our subsidiary. This one will be our associate. It will be an associate. And it is an associate from May to October. May to October, I believe those should be 6 months. Yeah, 6 months. It is an associate for 6 months. So it was an associate for a period of 6 months from the date of acquisition, that is from 1st May to that 1st of October. So we had it for 6 months. And that is the first thing that you needed to know, the structure, how the three companies are related. Therefore, Polo had acquired 90% of Solo, making Solo the subsidiary, and had acquired 30% of ALO, making ALO an associate. So during the consolidation, we shall only consolidate Polo and Solo, because we consolidate the holding of the parent and the subsidiary. This one we shall only account for the investment in associate. I'll do my workings. So that is part of my workings. So my answer, I'll answer it here. So I'll start with the first one. The computation of goodwill for each. So when you talk about for each, here is for ALO and for Solo and for ALO, the two of them, ALO and Solo. Okay, need it here. Yeah, that way. And still there will be in million of shillings. There will be in million of shillings. So for the goodwill, we start with the purchase consideration. What we paid. Purchase consideration. How much we paid. How much we paid to acquire them. Okay, so purchase consideration. So for this one, we are told here we acquired 90% of shillings 10 ordinary share, and we paid 30 per share. When you look at Solo here, the ordinary shares, Solo had 14,400 as the number of shares. 14,400 of 10 each. Here. So I will pick 14,400 divided by 10. Then, so when we divide by 10, we are getting 1440. Those are the number of shares that they had. Out of those number of shares, we only acquired 90. We did not acquire everything. We acquired 90% 90% of those shares, and we paid a price of 30. We paid a price of 30 shillings. So we are taking the number of shares that we had, 14,400. Then we divide by 10 to get the number of shares. This is in shillings. Number of shares. Out of that number of shares, we acquired 90%. We did not acquire 100, 90%, and we paid 30 per share, which will give you 38. Will give you 800 as the total amount that we paid to acquire Solo. The amount that we paid to acquire Solo. The same for Alo. So when you look at Alo's ordinary share was 72. Divide by 10 to convert them into the number of shares. We only acquired 30. We did not acquire all 30%. And one share we paid. So on 1st May, Polo acquired 30% of Alo, 10 shillings ordinary share, for 35 per share. In this case, we are paying 35 to acquire one share. One share we paid 35. So for Solo, acquisition was 38. For Alo, 75.60. And we have been given the fair value. So we are using the full for the subsidiary fair value NCI. So that statement in note number 2, which is a group policy to value non-controlling interest at acquisition date at fair value. The fair value of non-controlling interest in on November 1st November 21 was 36. It was 3,600 as our NCI, meaning that the total amount here, we shall be dealing with 42, and here we shall be dealing with the same value. We don't have NCI in Alo because Alo is an associate. We less fair value NCI, fair value net assets, fair value net assets. Yeah, at the date of acquisition, the fair value net assets that we had, fair value net assets. And remember, our net assets in this case will incorporate the ordinary shares. So we take the full amount of the ordinary, especially for the holding, because we are dealing with the full goodwill. Ordinary share 14. This other one we had 72, of which we shall take partial later on. Currently, I'm just picking the full amount for the ordinary shares. So remember, these are the net assets that they had, and they had only that one, the revenue reserve. Yeah, you can pick that revenue reserve, and the revenue reserve that we use is the pre-acquisition. This one that you have been told here. Polo Limited, we paid 30. The balance on Solo retained reserve, these are the revenue retained reserve at this date was 96. And for the revenue reserve, already we know this one. Yeah, this one already we have been given our revenue reserve, which was a 996 at the date of acquisition. We had 96, and this other one, remember, for this one we acquired it in the course of the year, so we acquired it in the course of the year. So we need to know the retained profit by the time we are acquiring it, Alo. So that's why we have note number 1. Note number 1. When we look at note number 1, they're telling us that the details relating to the revenue reserve was as follows. Revenue reserve as at 1st November 2022. So for Solo and for Alo, and we have the retained earnings for the year 16 and this, but for this one we had 96 and we had 72. 72 is what they made during the year. It means by the time we acquired it, already they had this at the beginning, 96 and half of this. Yeah, half of this, the retained profit for the period was the pre-acquisition. I can just note that. So pre-acquisition retained, pre-acquisition, acquisition revenue reserve, revenue reserve in ALO Limited. So this is a pre-acquisition revenue reserve in ALO Limited. So in ALO Limited, we are having the balance brought forward. So the balance brought forward, what they had here, yeah, revenue reserve at the beginning, it was that. And for the year, remember we acquired it for 6 months only, for 6 months. So the profit for the year that they made, 7.2, we shall multiply by 6/12. So part of it, half of it will be the pre, and the other half will be the post. Half is a pre, and the other half is a post acquisition. So that by the time we are acquiring it, it means that it had retained, or the revenue reserve was 13,200. By the time we are acquiring it, it had revenue reserve of 13,200 for this company. 13,200. That one that we have calculated, so brought forward at the beginning. So those years that we did not acquire it, it had 9.6, and during the year they made 7.2. That means by the time we are acquiring it, they had 13,200 here.
Mwalimu,
Yes.
can you just take me back where ALO was acquired?
Okay, so ALO was acquired at the beginning here on 1st May.
On 1st May.
Yeah, 1st May of 2023.
2020. Okay, then the first any statement, your additional information.
Yeah, the statement here we have the details relating to the revenue reserve for the year. So you have revenue reserve on 1st November, that is at the beginning of the year, and the retained earnings for the year. So the whole year they had 72, and at the beginning of the year they had 96. But remember, we acquired it on May. That means up to May, it will form part of the pre-acquisition. So that's why we are taking the 96 plus the 36. 36 is up to May. Up to May.
Okay, I have a different thought on it.
Uh-huh.
I don't know. In the statement of financial position.
Yes.
Here at the reserve.
Yeah, the revenue reserve.
The revenue reserve for the whole year.
Okay, so they had 16,800. So remember, 16,800 was the two of them.
For the whole year. But the one you have taken, I think by 1st November 2022 was the business exit. Were they in any?
So remember in
consolidation.
What happens is that what we have here, we had 16,800. 16,800 is a combination of retained profit brought forward and the retained profit for the year. So what we need is a pre, what they had before we acquired it. And what they had before we acquired it, at the beginning, we did not acquire it at the beginning, we acquired it in May. So the total out of the 16,800, the other way, we can take 16,800 minus the half. What we had as the post. Still, that one is another way you can get the pre-acquisition. The total was 16,800, and we minus the post from 1st May to 31st March, 31st October, which will be still 36. So 16,800 minus 36 still will end up getting 13,200 as the retained profit that they had on 1st May at the time that we are acquiring it.
Okay, Mwalimu.
Yes.
Just 1 minute.
Yes.
I was seeing it this way. Okay, this 9,600. We've not acquired this business yet.
Yes.
But that amount. So to get the correct one, I think we should take this 16,800. Then we less 7,200. Then whatever remained is what we multiply by 6 over 12, and I don't know, I was getting something different.
Yeah, so remember your approach when you talk about 16,800 minus 7,200, still you are remaining. When you minus the 2, you'll get 9,600. But remember the 9,600 on November. Yeah. So it is November, so you have to factor in up to May for the 6 months.
I've seen it where I missed when I was revising. Okay, thank you.
So 13,200. Then apart from that 13.2, so there was other statement that we had. Yeah, starting with note number 6. Number 6, we are told that on November 2021, on 1st November 2021, Solo Limited owned an investment property that had a fair value of 1440 million in excess of its book value. The value of this property has not changed since acquisition. So we have fair value gain for the investment property, which was 1440 in excess of the book value. So it was in excess of the book value. Excess of the book value. Okay. Let us see that new message. Okay. So I'll answer that because I think it's not showing its own things. So you have fair value gain.
The question she's asking is the retained earnings same as the revenue
Reserve.
is it the same?
Yeah. Retained earnings and revenue reserve is one and the same thing. Okay, thank you. Yeah, it's one and the same thing. So fair value in note number 6, fair value gain on investment property. So this one is for the property. And for the property we had 1440. This one, which was in excess of the book value. Okay, so thank you. It's the same thing. Yeah, when you talk about the retained profit, when you talk about the revenue reserve, and when you talk about there is another name, yeah, retained earnings. The earnings, the profit, and the reserves. Revenue reserve, they mean one and the same thing. Yeah, so that way. So you have the ordinary, therefore, for Solo, the revenue reserve, the fair value gain, and this one is for the property that we are dealing with. And there was one thing in note number 5. Yeah, note number 5, where we are told just prior to the acquisition, Solo Limited, Solo Limited was successful in applying for a 6-year license to dispose of waste product. The license was granted by the county government at no cost. However, Solo Limited estimated that the license was worth 2160 at the date of acquisition. So here is a license. And remember, license falls under the intangible asset IS 38, whereby even if we did not pay any cost to acquire that license, as long as you can get the market value of that particular license, we are supposed to account for it. Because in the event that you were to transfer or sell this license to another individual, then we should be able to sell it at the market rate, and therefore it becomes an intangible asset, because we shall be generating revenue because of investment in that particular license that we acquired, and therefore it forms part of our intangible asset, and it was supposed to be included here because it was not captured. The license of 2160, because that was the market value at the date of acquisition. I think that's all for that. So we get the total of this, and here we shall get the goodwill, our goodwill. So the goodwill will be the difference. Remember, here we are using the full goodwill method. So we shall have 14,880 as our goodwill. But when it comes to ALO is not full. For ALO, we are using what we call the partial goodwill method, where we need the sum of these two, the sum of 7.2 and 13.2. But now we shall multiply these. By 40. Not 40, but 30%. What we acquired, we only acquired 30% of those net assets. We did not acquire 100% of the net assets, only 30%. So the total of this by 30%, so that the goodwill of these will be 1440. Goodwill of this will be 1440. That was the first part for 4 marks. So goodwill in solo and goodwill in ALO. That was the first thing that you were to calculate. Then the second part of it, where we need now to prepare the statement of financial position. The statement of financial position. So this is Polo Limited. So Polo Limited, their group statement of financial position. So group statement of financial position. Financial position. So as of that 1st October 2023. Yeah, that way. And we start with the non-current asset that we have. And on non-current we shall have the PPE and the investment. PPE and the investment. They will be in million of shillings. So the PPE, we need to know it will be affected by which elements. Which elements? So we have this one, which we are calling the investment property. The investment property, which will still form part of our PPE, the non-current, or the property, plant, and equipment. So investment property will be forming part of that. And the one that we were given in note number 6, it was not depreciated because we are told that it had a fair value of 1440 in excess of its book value. The value of this property had not changed since acquisition, so it has remained at 1440. So there is no depreciation or there is no loss of value to that amount, meaning that we shall just consolidate. Remember, you said you are consolidating the two, Polo and Solo. ALO is an associate, so there is no consolidation to this one. So we add the fair value, this one, the fair value of the investment property, fair value of the investment property of 1. So the total you'll get 141,240, because in this case you're not including there's no any form of depreciation that you're supposed to deduct. For the investment that we had, and we shall deal with the intangible, the one for the license. For the investment, here we have been given investment. Polo we had 48 and Solo we had 10,920. But remember, Polo had invested in 2 companies. He had invested in Solo and we have invested in ALO. And the amount that we paid, the purchase consideration, remember this is what we paid. Solo we paid 38,880 and ALO we paid 75,660. So what we paid, these are internal investment, and we said for the investment we only record or we only report the external, only the external investment. So we shall add the two, and we minus our investment in Solo and our investment in ALO. So we are taking the amount that we had in Polo, the amount that we had in Solo, minus the internal investment, the amount that we invested in Solo and the amount that we invested in ALO, so that by the end of the day, whatever remains is the external investment, external businesses that have not been mentioned in this particular question, but we had other investments which were 12,480, and that's why when you add the two amount of investment in Polo and the one that was in Solo, they are more than the internal investment. So we only report that external, because for the internal already we have used the values in calculation of the goodwill. So intangible, if I can just put this, my intangible assets, we can separate these to include goodwill, intangible asset, to include my goodwill, because goodwill is part, and the license. Goodwill and license. But for the license, we shall amortize it. Goodwill was not impaired in this question, so there was no any impairment of goodwill. But for license, we were told that it was having 6 years. 6 years by the time we acquired it. It was for 6 years. Just prior to its acquisition, Solo was successful in applying for 6-year license to dispose of waste. It was for 6 years. 6 years. And remember, we are only calculating for 1 year because it's only 1 year that has lapsed since we acquired. So since we acquired it, it's only 1 year that have elapsed. So for the investment we have said is the total investment that we have. Polo had invested, the total investment was 48, but out of this 48, specifically for Polo, out of this 48, we had paid that 8,800 to acquire Solo and 7,560 to acquire Alo. So that 8,880 and that 7,560. In short, these two, if we are to combine these two, this is a total of 46 for 40. Out of these 48, 46 for 40, 46 for 40 was internal. The balance that remains in Polo is external. The one for Solo was external because Solo did not acquire any. We did not acquire anything internally. So this is what they had invested in other companies, short-term investment. And for this one, the short-term investment is 48 minus 46, the difference. That's why we are eliminating. We are eliminating them here. So here we have taken the two investments minus the two internal. What we had paid to acquire Polo, Solo, and what we had paid to acquire Alo. The two of them, we have eliminated them. And the key reason we are eliminating them, the values already have been used. The net effect is that the two values, instead of using them, we shall only report what? The goodwill. The extra amount that we paid in acquisition of the net assets in the two companies. That's why we are using only the goodwill, but the amount we don't record them again. Okay. So the goodwill already, we have dealt with that. Amortization was in this working. Amortization of license. Amortization of license. So this license, we shall take the value, which was 2160 for the license, and we divide by 6 because it was 6 years. So we shall have a value of 360 as our amortization cost of the license. The amortization cost of the license. We shall take 2160 and we minus this cost of 360, and we'll get that value of 1800 as our value for the license, the net. I think those are the assets that.
Mwalim,
yes.
You have forgotten one.
The
investment in associate.
The investment in associate. Sorry, thank you for that. Investment in associate. There is investment in associate. Investment in associate. Investment in associate. So we do that as a working for the investment. Number 4, investment in associate. Investment in associate. And for this one, we shall start with the purchase. What we paid, purchase consideration, and our purchase consideration was 7560. Purchase consideration, and we normally add the post acquisition profit. Post acquisition profit. So we add post acquisition profit after we had acquired them. After we had acquired, remember, after is the profit for the year, the one that we saw, our share specifically. So the profit for the year, the retained profit for that particular year, retained profit for the year. So we shall multiply by 6 months. That profit for the year by 6 months, and we multiply by our own percentage, which is 30. what we acquired. In short, is this 36, they have 36 by 30%, which will be 1080, which will be 1080. 360 multiplied by 30%, which will give you 1080. And remember, there was nothing else to deduct. We did not have any intercompany. Don't think we had any.
We had the parents sold an associate goods, so we need to separate the unrealized profit on closing stock.
Note number 4. Yeah, thank you. Note number 4. We are told in October 2023, Polo sold goods to Alo, for 780. They were transferred at a markup of 30% on cost. So two-thirds of these goods were still in the inventory of Alo as of that 1st October 2023. Yeah, we had this, the intercompany sales. So this one we shall just deal with it directly, or I can deal with it first here as a working, then we shall pick it from that. So intercompany sales, intercompany sales. So this one is Alo, Polo selling to Alo, and you'll find that the sales value for these goods, the sales value was 780 million, valued at 780 million. Therefore, our UPCS and realized profit will be 780. They were sold at a markup of 30%. Remember, 30% is on cost. 30% on cost. So you shall multiply 30 over 130. It was a markup, 30 over 130. And the proportion that remained, two-thirds of these goods were still in the inventory of Alo. So they did not sell two-thirds. Two-thirds still remained in the inventory. So 780. The profit element is 30 over 130. That is the profit element. And the proportion of that profit that was not realized is two-thirds. Two-thirds. So that our UPCS in this case will be 120. It will be 120. And remember, the person that is reporting this is Polo. Yeah, Polo, because it is a downstream. It's a downstream, Polo to Alo. So the entire amount here, the UPCS will be 120. Will be 120. 120 and negative 120. That is it. And I believe that was the only thing that we had there in note number 4. Number 3 was about the check. Yeah, that way. So the total.
Maybe Molim.
Yes.
There's an observation I wanted just to make concerning this. The quantity of those goods left in stock. Sometimes the examiner can be very tricky. He says that probably that a third of these goods were sold.
Yeah, that was sold.
So most of our students can rush. We calculate that figure using a third. Yeah. Instead of minusing one minus the third, we get the quantity of those goods that they remained in stock.
Yeah. Yeah, so you must be keen. Yeah, because even they can talk about, instead of talking about the two-thirds of the goods still held, they can talk about they sold two-thirds. If they sold two-thirds, it means what remains is a third. Yeah, that one is key. So you have to consider. Don't assume directly that when they talk about two-thirds is the one that is remaining. You have to read, in between the lines to know that the two-thirds, either it was sold or either it was the one that remained. And again, we are looking at who was selling. Because if it was the other way around, assuming it is Alo that was selling to Polo, this UPCS we should have taken our portion, 30%. If it was an upstream transaction, we are supposed to take only 30%. But in this case, because it was a downstream, the entire profit now is us that we are reporting the 120, so we are taking the whole 120. But if it was Alo selling to the parent, only 30%, because that is what we own in that particular company. Okay, so that is it here. We report that as our investment in associate with a 520, and we get our total here. Our total. So that's our total non-current asset. Then we deal with current asset, and for the current asset, we had three. So we had the receivable inventories first. Inventory, receivable, yeah, that way. So the inventories, receivable, and bank. So for the inventory, remember we are only consolidating the two. We are only consolidating the two, the inventory for solo and the inventory for polo, only the two of them. This plus this, the two of them. And remember here, we don't make a mistake of deducting what? The UPCS, because the UPCS was in ALO and it has been taken care of under the investment in associate. So we will not deduct it under the inventory, because ideally we are not consolidating ALO as it is as an associate. So its inventory will not affect our inventory. So that UPCS will not be considered when we are calculating this inventory. Then the other thing, for the receivable, there was a point. For the receivable, there was a point in note number, so note number 2, we had already dealt with it. Note number 3, a check of 80 million from Solo Limited to Polo Limited was not received until 3rd November 2023. The intercompany balances are included in the accounts receivable and payable as appropriate and payable. So to one company, remember intercompany, one company is a sale or is a receivable, and to the other company is a payable. One is a receivable and the other one is a payable. And in this case, the one that was a payable, it had already written a check. Yeah, it had already written a check of this value 480, but it was not received until the end, until after the end of the year. So that was a cash in transit. Therefore, the effect of that will be under the receivable. We shall add this one, and we add this, and we minus that 480. Because it was part of the intercompany balances. The 480 was part of the intercompany balances. So it will deduct, or it will reduce the value of the receivable. It will reduce the value of the receivable, because the one that had already paid had already deducted. So the receivable that in our books shows that already we have not received, but for him already he had made a payment. So we shall reduce the receivable by that value, because it is an intercompany balance. And again, we show it now in the bank under cash in transit. We add it as if already we had received the amount. So it will be this, and we add that 450, the 480, the 480 that we had, because this other one was a dash, they did not have something. So we add 480, for which the net effect is normally 0, because here we are minusing the 480, here we are adding the 480, but you're supposed to show that because it was here, it was included. So we deduct, we reduce the value of the receivable, and we add it in the bank because we have received the assumption already. We have received it. We shall get the total assets.
Mwalim,
Yes.
I think I have a different opinion from you, especially on inventory.
Okay, go ahead.
For the inventory, because the unrealized profit is on the parent.
Yes.
And therefore we should subtract it.
So we shall subtract from which inventory?
You'll just sum them up for the inventory for the parent and subsidiary, then you subtract it under. Because it is unrealized, because we are the one who sold, we as a parent.
So remember, ideally, what happens when we call it unrealized, because the effect or the reason you normally subtract it is it had already overvalued the inventory. So the closing stock, because of inclusion of the profit, is normally overvalued. And remember, when you look at IAS number 2, whereby we talk about the valuation of inventory, we normally value it at the law of costs and net realizable value. And because the value that was there had a profit, meaning that inventory was overvalued, so we take the lesser by deducting that value that was overvalued, the unrealized profit, because it was not realized. So in this case, The reason we are not deducting it is the inventory that was overvalued was the inventory for the associate, for Arlo, because we had sold to Arlo. So the inventory that was overvalued was for Arlo, but not for Polo. So because ideally you're supposed to minus it from a specific inventory, not by the time that we are summing the Polo and the Solo we minus, no. It is deducted from a specific inventory. And in this case, if you are to consolidate Arlo, when we are summing the three of them, then when we are minusing that 120, ideally we are minusing it from these 300. We are minusing it from 300. Yeah, we are minusing it from these 3,000, and that's why we are not deducting, because it was the associate. And again, remember, the moment we have included it in the investment in an associate, that is already double entry. We have deducted it in investment in associate, and it will go to the retained profit, whereby it will cancel one another. So that's why we are not including it under the inventory. So that is the argument for that, because the inventory for Arlo, we are not consolidating that, and that's where the UPCS arose from. Okay, so we add the two to arrive at 205,560 as our total assets. Then we had the other part for the finance or equity and liability, and here we start with the ordinary. So there are only two, the ordinary and the revenue reserve. And remember, we did not have share for share exchange. So it was a cash payment, because we are paying 30 shillings, and the other one we are paying 35 shillings. So it was a cash transaction. So we only take the ordinary shares for the ordinary share for the holding company. That is for Polo only. Polo only is what we are taking. Sorry. So this one, I just need to make them bold. So ordinary for that one, for ordinary, 60 for parent. So for the revenue reserve, we do that as a working. Number 6, revenue reserve. And for this one, we take the one for Polo, what they had as our revenue reserve. So Polo had 87,600. Then we take for Solo, but now for Solo, remember, we shall take what? The post. Solo, we take the post acquisition. So this is a post. You can write here, post acquisition profit. When we talk about the post, is after already we had acquired it. And to get the post, we take the revenue reserve at the end. At the end, we had 26,400. That was the total. We minus the pre. Pre is what we use in the Goodwill. What we use in the Goodwill, the revenue reserve, which was 96. 96 was the pre, and you multiply by our share, 90%. So we are taking the retained at the end of the year. We minus the pre, what we had at the time of acquisition, and we take 90% of that, 90%, which will give us 15,120 as the post acquisition for Solo. Arlo we had already calculated in the investment in associate. Remember, here we had post acquisition profit. So we just pick that. The 1080. Again, this is a post. This is a post acquisition profit for Arlo. Then after that, we have now these others. Arlo had UPCS. The whole amount that we had amortization of license. So we shall take our portion of these, because this license belonged to Solo, and Solo is 90% subsidiary, 90% holding, and 10%, 10% NCI. So we take our portion of that, the 90%, because the license was for solo 90 and 10. The other one will take the 10%. I think those are the two elements that were to deduct, the UPCS and the one for amortization of license. We did not have any other thing that was being deducted there. So the total of this will be that value 103, 356. Here, take this, and this is attributable to parent. Yeah, so attributable to parent or holding, attributable to holding company, attributable to holding company, that one. Then we calculate the NCI share of net assets, NCI share of net assets. So for the net assets of NCI, then we can work it out, that one. Yeah, NCI share of net assets. So we start with the fair value. We had fair value NCI here, the fair value NCI, which you are given as 36, and we add the post. Yeah, the post acquisition profit, and remember this is a post acquisition profit in solo. Yeah, so this one is a post acquisition profit in solo, because that's where the NCI, we find the NCI there. So we shall check the value the way we did here, the poster. So we take the value at the end, 26, we minus the pre at the time of acquisition, the pre of 96, and we multiply by our percentage. So here is the NCI. NCI we are taking 10%. NCI we are taking 10% of that. And the amortization for them, the only thing they'll take is the amortization of 360 by their proportion of 10%, which will be 36. So that those are the only two items that we are adding. So fair value, then we add the post acquisition and we less the amortization. If we had goodwill, we could have deducted that if goodwill was amortized or was impaired, but in this case the goodwill was not. We did not have any change in the value of goodwill as far as the information we have been provided is concerned. So here we pick this 52.44 and we get the shareholders value, shareholders wealth, or shareholders value. Yeah, shareholders wealth or value, and the total of the two, that way, 16,800. Then we go to the other part of the non-current liability. And non-current liability is a simple addition of the debenture that we had. It was only the 10% debenture, nothing else. So just simple addition of the two. Then the current liability. And current liability, I think there were two. Yeah, there were three. Even the bank overdraft. We'll drag this to include the bank overdraft that way. So for the current, we'll do it here. Simple addition to the current liability. So we add this and we add this. I think the three of them will just be simple addition. Remember for the payable, according to note number this one, The intercompany balances are included in the accounts receivable and payable as appropriate. When they talk about as appropriate, remember it was this 480, which was in both, but already one firm has already paid. That's why we deducted in receivable, we added it in cash or in bank, and that one was cancelled. And that was the only transaction that we included. It was the only transaction that we are supposed to include, because we are not deducting it again in the receivable, because already the money was received. The money was already received. And we drag this so that you can capture. Okay, so this one we shall just deal with it because of the dash. This one is one that is bringing an error, so just pick this value directly. We get the total for this total, and here we add the three of them. Okay, shareholders, you're supposed to put a top column or border. Yeah, we get this 205 560. So here I'll put the top border that way, and this is our total equity and liability. Liabilities. Yeah, so that's how that question was supposed to be done, the way the question was supposed to be done. Yeah, for the calculation of goodwill and the calculation of the statement of financial position. Remember, we said for this one, maybe you may not be accurate, but you can get the maximum. Yeah, your key thing is to make sure you get the maximum max possible. Yeah, like when you look at the trade payable, as long as you understood the part for the cash in transit, and that you are only supposed to adjust it in the receivable and in the cash, that means the three of them, the payable, current, tax, and bank overdraft, these are free marks because it's just backpasting the values as they are. The same with the debenture. So these two, they need working. The revenue reserve and the NCI, you need to do working for that. Ordinary, you're just picking. Here you just need to know whether you have UPCS, especially UPCS that is affecting the subsidiary and the parent. The subsidiary and the parent, not the associate. The associate will go directly to the investment in associate. It will not be captured under the inventories. So then for the receivable, you just need to know whether we have intercompany balances, and whether we had any cash in transit, so that we can adjust that. We had any cash in transit, we shall adjust that in the value for bank. For the PPE, you need to know the fair values that we had, if we had any gain, whether we had any depreciation on those fair value, yeah, whether we had any, what we are calling the UPFA, intercompany disposal of assets, and those disposals, whether they give rise to the depreciation and a charge, so that you can be able now to do the correct adjustment on the profit, or not the profit, but the correct adjustment on the PPE. The investments, you need to look at whether the value, sometimes or most of the time you may find that the value do agree. The total investments and the total amount that we invested in the companies, they do agree. If they are tallying or they are reconciling, that time we don't account for it. We shall not show anything because the value are equivalent. What is shown in the statement and what we invested in the two companies, then that one cancels out one another. When calculating goodwill, consider whether you are using the full or you are using the partial, whether it is a full goodwill or it is the partial goodwill method that you are using, so that you know. And remember, when you talk about the full or partial, it only applies to the subsidiary, not to the associate, because associate you cannot have the full, because you're just acquiring lesser than 50%. But for the subsidiary, you can acquire, and given the value, fair value of what? The NCI. And remember, the fair value of NCI, it's not a must for you to be given. Yeah, we said you can calculate the fair value of NCI as long as you have been given the share price of the subsidiary. If you know the share price of the subsidiary, and like in this case we acquired 90%, the 10% of the shares multiplied by the value of one share, that is the market value of the share of the subsidiary, that time you can be able still to get the fair value of the NCI. But if we are using the partial, then there is no need of the fair value. You will not be given the fair value of the NCI. We'll just continue using the partial.
Mwalimu,
Yes.
I have a question where they don't give the value of NCI. But now you check on the net assets of the subsidiary.
Yes.
Then you take a portion of the NCI.
Yes.
Now will you consider that as being the fair value of NCI?
No, that is not the fair value. So that one is the partial. That one I will consider that when you are calculating here the NCI share of net assets. The NCI share of net assets. So instead of starting with the fair value NCI, we shall take the NCI share of NCI net assets. We take this value, assuming like here, we could have taken 4,800 by 10%. Then we do the normal adjustment. So for the fair value, they must give you either the price, the market price, that is the prevailing, or they give you the exact amount of the fair value. If they don't give you the exact, they have to give you the market price of the share of the subsidiary. So that one is what you will use. But when they talk about the proportion, that one just know you're dealing with the partial. Proportion of net asset, that is the partial, not full. Okay, I think that's so another question. Yeah, so why did we not calculate the share premium since they bought at a higher par value? Why did we not calculate the share premium? So they bought it at a higher value. Yes, they bought it at a higher value, but remember now, in this case, we did not calculate the share premium because that is the value that we paid, the purchase consideration. So to acquire the shares that they had, we paid at a price of 30 shillings. We paid at a price of 30. And remember, most of the time when we are dealing with what? The share exchange. That is the time now we calculate the share premium during the share exchange. In this case, we are acquiring the shares, but those shares, we are paying them in cash. Remember, when we are dealing with mergers and acquisition, the forms of payment, you can either pay in cash, you can either pay using the share exchange, or you can give them the convertible securities. Yeah, either the debentures or the preference. So in this case, one form of acquiring these shares, we paid them using cash, and therefore there was no any exchange of shares, and that's why we have not consolidated the shares. We have only taken our own share because our share will not change. The share capital that you have will not change, so therefore there will not be any share premium. Yeah, the only thing, we paid a higher price to acquire those particular share, even if their par value was 10, but we paid at the market value, and that's why now we are having the goodwill, the goodwill, because their book value was 27, but because we paid at a higher value, that's why we are having a total value of 42. Yeah, thank you. So that way